Now to our first newsmaker of the hour, Minneapolis Fed President Neil Kashkari. Our own Steve Leisman is joining us on set for this conversation as well. But Neil, first of all, thank you for coming into set today. It's great to see you.
Great to see you. Congratulations on your spinoff.
Thank you very much. Everybody's waiting to see what the Fed does this year, what happens. And I know you've been pretty clear that it's going to be a data-dependent situation. You don't think the Fed should be automatically making moves any direction or another. So let's get right to what you think about, first, the jobs market, and second, inflation. Where do you see things right now?
I mean, the job market is clearly cooling. There's no question about that. We see this in the national statistics. The unemployment rate is up now to around 4.6%. I think that's a real, there's a lot of questions on some of the data. I think the unemployment rate is pretty clean at 4.6%. When I talk to businesses in my region, they also say they're not hiring very much. So I think that that's a clear signal that the labor market is cooling.
Absolutely. Totally agree. I was just having a conversation with a good friend of mine who has always had a job, got laid off by a major company here in the Bay Area, and has been looking for work for almost 7.5 months, maybe 8 months now, and says that he puts in applications every single week, has a background in engineering, and just could not find work. Is currently doing, DoorDash, Ubering, stuff like that, delivery services type of work. And I've said it before, I'm gonna keep saying it again. This is a year where we have to self-sustain when it comes to making money. There's no guarantees anymore. Jobs just aren't hiring. Could be due to inflation, could be due to just technology, AI, to tariffs. But I think all of this is kind of culminating at once, and we've never really seen this before. It's usually been one thing or another, but not really a total a total bombardment of ways not to earn money, right? When jobs stop hiring, then there's a real problem in the economy. And I suspect that the number that we need to look out for is unemployment getting to about 5%, right? I don't think it's been that high since the 1920s, maybe a little bit after that. But I mean, right now we're at 4.6. We just got through the holiday season. Q1, Q2 will be a telltale sign for the job reports. And if we don't start seeing jobs start to pick up the pace here come January and February, it's going to be a rough year ahead for a lot of people.
At the same time, inflation is still too high. I think the most recent inflation data, I don't take that seriously because there's some issues with the data collection with the shutdown. I think inflation is still too high. And the big question in my mind is, how tight is monetary policy? Over the last couple of years, we kept thinking the economy is going to slow down, and the economy has proven to be far more resilient than I had expected. That tells me, well, monetary policy must not be putting that much downward pressure on the economy. And so my guess is we're pretty close to neutral right now. And we just need to get more data to see which is the bigger force. Is it inflation or is it the labor market? And then we can move from a neutral stance, whatever direction.
I think it's both. And that's what I just said. I think right now you're seeing a weakened labor market because of tariffs, because of inflation, because of technology. All those things are converging at once. So it's hard to point at whose fault it is, right? You can't stop technology from growing. I mean, we're seeing AI do everyday jobs for people. I use AI, you use AI, everybody is using AI for one thing or another. So that's going to be a part of our lives for the rest of the foreseeable future. What you do with it is up to you, right? If you're just sitting on here and twiddling your thumbs and making lists of, what amazing restaurants to go look into, well, then you're using it the wrong way. You should be using it for productivity and helping you figure out things, how to, monetize yourself. Because right now, and here's the other thing, right? The Fed wants to, well, I shouldn't say once. The Fed isn't going to just willy-nilly wants to lower interest rates, right? They want to print more money. They want to sell off their debt. That's not happening anymore, right? And they don't want to go out of business, I think, ultimately, right? And I think they're going to have some decisions to make here in the near future. But again, you have all these particular factors converging in on once, and it's really hurting at the end of the day, you, the American person who is not working. If you're not working right now, I definitely will say, open up that book, get those gloves, open up that toolbox, go back to school, because you're gonna have to pick up some new skills that essentially you're gonna have to take, precedence in your life for the foreseeable future. Again, my opinion, totally could be wrong about these things. Just trying to give you guys my 2 cents here.
Necessary.
But your gut tells you right now that the labor market is maybe the bigger issue to wrestle with at this point?
Probably. I don't think we're going to be surprised that inflation ends up being much higher than we are seeing right now. I think
That's
the
exactly what I was saying.
inflation risk is one of persistence, that these tariff effects take multiple years to work their way all the way through the system. Whereas I do think there's a risk that the unemployment rate could pop from here.
Well, that's really weird then, Neil, because we've been above 2%, 50% above 2% for 2 years then. The Fed has totally missed that target, and we've just cut 4 or 5 times. So that makes no sense. Then you've moved the goalpost to 3%.
No. I don't think we have moved the goalpost at all. I think the debate that we've been having at the committee is, we know that tariffs affect goods import prices. Do you count that as a one-time effect, or do you think it leads to something more persistent? That's the debate that we've been having.
But
I'm going to chime in and leave it here. I think that tariffs are going to level out, when things get settled. I think the main issue here is printing of money, which we know is how the Fed likes to fix things. And the more money that's being printed, the less valuable the dollar becomes. And also, and something that they're not talking about right now, is that you're getting real world assets like precious metals, Bitcoin, crypto. These things are starting to increase in value again because the dollar is destabilized. And again, going back to my initial thought, this is all about all these forces converging in at the same time, right? When you lower interest rates, which we definitely want lower interest rates, but that could affect another thing like the housing market. Typically with lower interest rates, you're going to lose value. So we're very intriguing. I don't think tariffs are going to are solely to blame. I think you have a weak job market. I don't think companies are hiring right now, which is making it harder for everyday folks. I'm going to keep saying it. Got to go out there, got to be prepared to utilize the tools that you have already within technology and skills that you've developed over time. Because we are definitely in uncharted waters. And this is going to be a theme for the 2026 and beyond. So with that being said, you guys, this is Saving America's Money. Let me know what you think in the comments. Like and subscribe. Stay strong, stay safe, and continue to save America's money. Peace.